Have you ever wondered how to evaluate investment risk? It's a question that stumps even the most seasoned financial enthusiasts. Investing isn't just about reaping high returns. It's about understanding and managing the potential risks that come along with it. In the financial world, risk and reward are two sides of the same coin, and understanding this relationship is vital to making sound investment decisions. But fear not, we're here to guide you through the labyrinth of investment risk. In this video, we'll dissect the various types of investment risks, uncovering their unique characteristics and impacts. We'll then move on to showing you how to assess these risks, providing you with the tools to make informed decisions about your investments. And of course, we'll explore strategies for managing these risks to protect and grow your portfolio. So buckle up as we delve into the world of investment risk. To evaluate investment risk, you first need to understand the different types of risks that exist. Let's delve into the main types of investment risks. First off, we have market risk. This is the possibility of an investor experiencing losses due to factors that affect the overall performance of the financial markets. For instance, if the stock market crashes, your investments in stocks will likely take a hit, regardless of the individual performance of the companies you've invested in. Next, we have credit risk. This is the risk that a borrower will default on any type of debt by failing to make required payments. If you own a corporate bond, for example, there's a risk that the company may not be able to pay back its debt, affecting the value of your investment. Thirdly, there's liquidity risk. This is the risk that an investor might not be able to buy or sell investments quickly at a fair market price. For instance, if you need to sell a large amount of a particular stock quickly, you might not be able to find enough buyers, forcing you to sell at a lower price. Lastly, we have inflation risk. This is the risk that the value of assets or income will decrease as inflation shrinks the purchasing power of a currency. If the rate of inflation exceeds the earnings on your investment, then you might actually be losing money in real terms, even if the nominal value of your investment is growing. In essence, market risk involves the entire market moving against your position. Credit risk involves one party in a transaction not living up to their financial obligations. Liquidity risk involves not being able to conduct a transaction at prevailing market prices due to an imbalance in supply and demand. And inflation risk involves the general level of prices for goods and services rising at a rate that outpaces your investment's rate of return. Now that you know the types of risks, let's move on to how you can assess them. Assessing investment risk isn't as daunting as it sounds. It's all about understanding the dynamics of the investment arena and taking calculated steps. To begin with, thorough research is key. Dive deep into the intricacies of the company or the asset you are considering. What does the company do? What are its products or services? Who are its competitors? How does it fare in the market against them? These are just a few of the questions you should be asking. Next, understanding the company's market position is crucial. Is it a leader, a follower, or an innovator? Remember, where the company stands in the market can give you a good idea of its stability and potential for growth. Once you've got a grip on the company's standing, it's time to roll up your sleeves and dig into the financials. Analyzing financial statements isn't just for accountants. Anyone can do it, and it's an essential part of assessing investment risk. Look at the company's revenue, expenses, profits, and debts. Is it making money? Is it in debt? How does it manage its cash flow? These factors can give you a clear picture of the company's financial health, but don't just stop there. Consider external factors that can influence your investment. For instance, economic conditions can have a significant impact on a company's performance. In a sluggish economy, even the best companies can struggle. Similarly, regulatory changes can either be a boon or a bane to your investment. Always keep an eye on the broader economic and regulatory landscape. Finally, let's talk about diversification. It's a word you'll hear a lot in the investment world, and for a good reason. Putting all your eggs in one basket is a risky strategy. Instead, spread your investments across different assets and sectors. This way, if one investment doesn't perform well, others might. So there you have it. Assessing investment risk involves researching, understanding the market position, analyzing financials, considering external factors, and diversifying your portfolio. Understanding the risk is half the battle, but what can you do to manage it? Managing investment risk is an essential part of any successful investment strategy. Now, let's delve into how you can do just that. Start with diversification. Think of it as not putting all your eggs in one basket. Diversification means spreading your investments across a variety of assets, sectors, and geographic locations. It's a way to mitigate the risk of a single investment tanking and taking your whole portfolio down with it. Next, consider investing in safe assets. While they might not offer sky-high returns, they provide a cushion for your portfolio. Treasury bonds, for instance, are backed by the full faith and credit of the U.S. government, making them a safe bet. Setting stop-loss orders is another strategy. These are designed to limit an investor's loss on a position in a security. It's like an insurance policy for your investments. It won't prevent a loss, but it can stop a bad situation from getting worse. Finally, rebalancing your portfolio regularly can help keep your risk level in check. This involves adjusting your portfolio back to its original asset allocation to maintain the level of risk you're comfortable with. So that's the rundown on managing investment risks. It's a delicate balance of minimizing potential losses while maximizing potential gains. And it's not a one-time thing either. It requires consistent attention and adjustment. Remember, managing risk is about making informed decisions, not avoiding investments altogether. So there you have it, a quick guide on how to evaluate and manage investment risk. We've touched on the various types of risks, from market to liquidity, and how you can assess them. We've also discussed strategies for managing these risks, such as diversification and asset allocation. Remember, the journey to investment wisdom is continuous. Don't shy away from taking calculated risks. The key to successful investing isn't avoiding risk, but understanding and managing it. So equip yourself with knowledge and make your money work for you.